Listen carefully because this is the kind of setup where retail gets absolutely destroyed on both sides. Euro is sitting at 1.1786, and directly above it is a resistance wall at 1.1800 that has rejected price 3 times in the last 4 sessions. Every single retail trader watching this level is either buying the breakout or fading it, and one of those groups is about to get liquidated. There is one danger zone and one hidden opportunity today, and I will show you both. Stay with me because at the end I am giving out 3 exact entry levels, 3 stop losses, and 3 targets you can use right now to trade whatever direction this resolves. If you think you know what happens next, you probably do not, and that is exactly why you need to watch every second of this breakdown. Here is my session bias right now. The daily trend is bullish, the 4-hour trend is bullish, but the 60-minute chart is telling a very different story that the higher timeframes have not priced in yet. My official verdict for this session is trending with a trap risk above 1.1800. That means I am leaning long on pullbacks, but I am absolutely not chasing a breakout unless specific conditions are met that I will give you in the trade setup section. The one invalidation level that proves the entire bull structure wrong is 1.1670. Write this number down. 1.1670. If we close below that level on the 4-hour chart, the entire daily uptrend is in question and we are likely headed for 1.1655. Then 1.1450 where the 200 period moving average sits on the daily chart. If you are long anywhere above 1.17, 1.1670 is your line in the sand. No ambiguity. That level breaks and the structure shifts from buy the dip to sell the rally. Type that number in the comments right now. Let me see who is actually paying attention. 1.1670. Write it down and tell me in the comments what you think happens if that level gets tested today. Let me walk you through the chart exactly as I am seeing it, starting from the weekly structure and drilling down to the 60-minute time frame where the real story is developing. On the weekly chart, Euro to US dollar is in a clear uptrend that started from the 1.06 handle back in October. The moving averages confirm this. The 20-period weekly moving average crossed above the 60-period moving average about 4 weeks ago, and price has been riding above both ever since. The 200-period moving average on the weekly chart is still flat near the 1.12 zone, which tells me the long-term trend is transitioning but not yet fully confirmed as a structural bull market. The weekly MACD is still printing higher highs on the histogram, which means momentum on this time frame remains supportive of higher prices. This is not a chart that wants to collapse. This is a chart that wants to grind higher but is fighting a resistance cluster that goes back to August of last year. Now drop down to the daily chart and this is where the picture gets more nuanced. Price is above the 20-day moving average, above the 60-day moving average, and above the 200-day moving average. That is a textbook bullish alignment, all 3 stacked in order with price on top. The 200-day moving average is sitting at 1.1450 and curving higher, acting as the structural floor for this entire move. The 20-day moving average is at 1.1720, and that is the first dynamic support that pullbacks should respect if the bull trend is healthy. The daily MACD is still positive, but here is the first warning sign. The histogram bars are starting to shrink. They are still green, still above zero, but the rate of change is decelerating. This is what I call early exhaustion, not a reversal signal yet, but a caution flag that the trend is losing impulse just as it approaches a major horizontal resistance. Now zoom into the 4-hour chart and this is where things get interesting for active traders. The 4-hour trend is still technically bullish with price above all 3 moving averages, but the MACD on this time frame is showing something that should make every Euro bull pause. We have a negative divergence forming. Price made a higher high near 1.1800 on the last push, but the MACD histogram made a lower high. That means buying pressure is weakening even as price is grinding up. This does not mean sell immediately, but it does mean that buying a breakout above 1.1800 without confirmation is a high-risk proposition. The 20-period moving average on the 4-hour chart is at 1.1746, and that is the near-term trend proxy that has held every dip for the last 5 days. As long as pullbacks stay above this level, the 4-hour structure remains buy the dip intact. The 60-period moving average on the 4-hour is at 1.1710, converging almost perfectly with the daily 20-period moving average, which makes the 1.1710 to 1.1720 zone a high confluence support cluster that buyers should defend aggressively. Now let us talk about the 60-minute chart because this is where the trap is being set. On the 60-minute, we have a compression pattern forming. Multiple candles are coiling just below 1.1800, with lower highs on the MACD and a series of wicks above 1.1790 that keep getting rejected. This is a spring being coiled. Either it releases upward in an explosive breakout above 1.1820, or it fails and snaps back to 1.17, potentially 1.1689. The 20-period moving average on the 60-minute is at 1.1780, essentially flat, telling you that short-term momentum is completely neutral and waiting for a catalyst. The 60 and 200-period moving averages on the 60-minute chart are both sloping gently upward near the 1.1750 area, so the path of least resistance is still up structurally, but the negative divergence on the MACD is the counterweight that cannot be ignored. Here is what most traders miss when they look at this setup. They see a bull trend and they blindly buy the breakout above 1.18. They do not check the crosser-set signals that I am about to give you. The dollar index is not confirming this euro strength cleanly. DXY is breaking down, yes, but it is doing so in a choppy, unconvincing way that suggests the dollar weakness is more about positioning than genuine macro flow. And when I cross-check euro to US dollar against pound sterling to US dollar, the pound is actually outperforming the euro on the crosses, which means euro-specific demand is not as strong as the headline move suggests. If this was a genuine euro bull run driven by ECB hawkishness, you would see euro to pound sterling ripping higher too. It is not. That tells me this euro to US dollar rally has more to do with dollar weakness than euro strength, and that kind of rally is vulnerable to sharp reversals when the dollar catches a bid. Let me give you the exact levels that matter today. Support levels that buyers must defend. First, 1.1746. That is the 4-hour 20 period. Moving average and the first line where dip buyers should step in. Below that, 1.1710, the convergence of the 4-hour 60 period MA and the daily 20 period MA. This is the critical short-term support zone. If that breaks, 1.1689 is the next horizontal support from last week's consolidation low. And then the ultimate line, 1.1670, the level I told you to write down. That level breaks and the structure is compromised. On the resistance side, 1.1799 is today's immediate ceiling, followed by 1.1820, which is the high from 2 weeks ago. Above that, 1.1850 is the next structural resistance from earlier in the year, but we deal with that only if 1.1820 falls cleanly. Every single trade setup I give you today will reference these levels exactly, so you know precisely where to place entries, stops, and targets. Now let us connect what happened in the last 24 hours to the price action you are seeing on the screen because the technicals are only half the picture. Yesterday's ECB speaker commentary changed the short-term narrative in a subtle but important way. Multiple ECB officials, including some typically hawkish members, signaled that the pace of rate cuts or the pace of normalization discussions is not as aggressive as markets had priced. The message was essentially, we are data-dependent, inflation is coming down but services inflation is sticky, and we are not in a rush to make any dramatic moves. This verbal intervention, whether intentional or not, has put a soft cap on euro enthusiasm right at the 1.1800 resistance zone. The market had been pricing in a more aggressive ECB stance relative to the Federal Reserve, and that spread compression trade was the engine driving euro to US dollar higher. When ECB speakers push back even slightly, that spread trade pauses, and the result is exactly what you are seeing now, a stall ride at resistance. But here is the other side of this trade, and this is why the bull case is not dead, it is just resting. The Federal Reserve is still on track to cut rates, and the US economic data pulse has been softening. The 2-year yield differential between German bunds and US treasuries has narrowed significantly over the past 6 weeks, and that structural trend has not reversed. It has just paused. As long as the Fed cutting cycle remains intact and the ECB is slower to move, the fundamental tailwind for euro to US dollar remains in place. The question for today and this week is whether the technical exhaustion at 1.18 creates a short-term pullback within that broader uptrend, and that depends entirely on whether support at 1.1670 holds. Let me cross-link this to the other assets I cover daily because the intermarket signals are critical for timing euro entries. First, euro to US dollar and pound sterling to US dollar are both trading as dollar antagonist pairs right now, but the policy differentials between the ECB and the Bank of England are diverging. The Bank of England is facing stickier inflation than the ECB, which means the bow is likely to keep rates higher for longer relative to the ECB. That is why euro to pound sterling has been under pressure even as euro to US dollar has rallied. If you are trading euro to US dollar, you must watch euro to pound sterling as a confirmation signal. A falling euro to pound sterling cross while euro to US dollar rises is a warning that euro strength is not organic. It is borrowed dollar weakness. If euro to pound sterling starts to turn higher alongside euro to US dollar, that would be the genuine euro bull confirmation I am waiting for to get aggressively long. Second, the gold to oil crosscheck for inflation expectations matters for the euro right now. Gold is holding elevated levels on geopolitical bid and central bank buying, while WTI crude is grinding higher on supply concerns and geopolitical premium in the Middle East. When both gold and oil are elevated simultaneously, it signals that inflation expectations are becoming unanchored to the upside. That is bad for the ECB because sticky inflation limits their ability to cut rates. But it is also bad for the dollar in the medium term because it erodes real yields. This creates a two-way fundamental tension for euro to US dollar. In the short term, elevated oil prices hurt the European economy more than the US economy, so a continued oil rally could cap euro upside. But if the inflation pulse forces the Fed to delay cuts while the ECB has already signaled caution, the rate differential could widen again in favor of the dollar, and that is a euro negative scenario. This is the complexity that makes trading euro to US dollar right now about more than just looking at a chart. Third, the US dollar index and S&P 500 liquidity tide is critical. The S&P 500 has been rallying, risk appetite is healthy, and that typically supports the euro as a risk-on currency. But we are seeing early signs of breadth deterioration in the equity market, fewer stocks participating in the rally, and that often precedes a risk reset. If the S&P 500 corrects and the VIX spikes, the dollar gets a safe haven bid, and euro to US dollar would sell off regardless of the ECB narrative. Watch the S&P 500 futures in the New York session. If equities start to roll over below their own key support, that is your early warning that euro to US dollar could struggle to hold above 1.17. Here is my 1 to 2 week directional lean for euro to US dollar. I am structurally bullish as long as 1.1670 holds. The path I see is a short-term pullback or consolidation between 1.17 and 1.18 for a few more sessions, followed by a breakout above 1.1820 that opens a run toward 1.19 and eventually 1.20. The exact event that would invalidate this thesis is a decisive 4-hour close below 1.1670, which would flip my bias to neutral bearish and target 1.1655, then 1.1500. The event that would confirm the thesis is a 4-hour close above 1.1820 with volume, and with euro to pound sterling also turning higher. That double confirmation would give me the green light to add size on the long side. Until then, I am trading the range with a bullish bias, respecting resistance, and buying support. Most people will click away right now because the analysis part is over and they think they know enough to trade. That is a mistake. The next section is exactly where money is made because I am giving you the precise levels where I will be executing my own trades, with exact entries, exact stops, and exact targets. If you skip this, you are gambling, not trading. Stay with me. Strategy 1. This is the sniper, the conservative play for traders who want high probability and are willing to wait for confirmation before entering. The trigger condition for the sniper is a 4-hour close above 1.1820, and I mean a clean close, not a wick, not an intra-session poke. The candle body must close above that level on the 4-hour time frame. Once that prints, the entry is on the retest of 1.1820 as new support. If price closes above 1.1820 and then pulls back to touch that level again, You enter long at 1.1825, giving yourself a small buffer above the exact number to account for spreads and slippage. The stop loss goes at 1.1780, which is 35 pips below entry. And here is the logic for that stop placement. 1.1780 is below the previous resistance zone and below the 60-minute 20-period moving average. If price breaks back below that level after a breakout, the breakout is a failure and you do not want to be in that trade. The stop is clean, logical, and placed where the structure invalidates. Target 1 for the sniper is 1.1870, which gives you a 45 pip gain and a risk reward of approximately 1.3 to 1 on that first target. At target 1, take 50% of your position off and move the stop to break even on the remainder. Target 2 is 1.1920, extending the gain to 95 pips and bringing the total risk reward on the full position to roughly 2.7 to 1. That is a professional grade setup with asymmetric payoff. What voids the sniper setup? If price breaks above 1.1820 but immediately reverses and closes back below 1.1800 on the 4-hour, that is a failed breakout, what I call a bull trap, and no long trade should be taken in that scenario. Wait for the next setup instead of forcing a trade that the market already rejected. Now I want to hear from you. Type your euro to US dollar range for tomorrow in the comments right now. Give me your high and your low for the next 24 hours. I am reading these comments after the session and I want to see how aligned this community is. Drop your range now. Strategy 2. This is the active trader, the standard play for those who want to trade the pullback within the existing trend rather than waiting for the breakout. The entry condition for the active trader is a pullback to the 1.1720 to 1.1746 support zone. This is the confluence of the daily 20-period moving average at 1.1720 and the 4-hour 20-period moving average at 1.1746. When price enters this zone during the London or early New York session, you look for a bullish rejection candle on the 15-minute time frame, a pin bar, a bullish engulfing, or a series of higher lows that confirm buyers are stepping in. Entry is at 1.1730, right in the middle of the zone, after that rejection signal appears. Do not blindly set a limit order. Wait for price to show you it respects the zone first, then enter. The stop loss for the active trader goes at 1.1685, which is 45 pips below entry. The logic for this stop placement is critical. 1.1685 is just below the horizontal support at 1.1689 and below the 1.1670 invalidation level I emphasized earlier. If price breaks below 1.1685, it is likely heading to test 1.1670, and if that breaks, your long is wrong. By placing the stop at 1.1685, you are giving the trade enough room to breathe through normal volatility while protecting yourself from a structural breakdown. Target 1 for the active trader is 1.1780, a 50-pip move from entry, giving you over 1-to-1 risk-reward on the first portion. At target 1, take 50% off and trail the stop on the remaining position to break even. Target 2 is 1.1820, the resistance ceiling, extending the gain to 90 pips and roughly 2-to-1 risk-reward on the full trade. Here is an additional rule for the active trader. Once target 1 is hit and your stop is at break-even, apply a trailing stop of 30 pips on the remaining position. If price continues toward 1.1820, you ride it. If it reverses, you lock in a small profit instead of giving back the entire move. This trailing mechanism is what separates profitable active traders from those who watch gains evaporate. What voids the active trader setup? If price drops through the support zone without any rejection signal and trades below 1.1685 with momentum, confirming sellers are in control. In that case, do not try to catch a falling knife. Let the 1.1670 level get tested and reassess. There will be another trade. Forcing a long into a breakdown is the fastest way to blow up an account. Strategy 3. This is the Aggressor, the high-risk play for traders who are comfortable with tight stops and understand that counter-trend trades or momentum chasers require aggressive risk management. This is not for beginners. Only take this if you know how to lose small and manage risk aggressively. The Aggressor setup is a false breakout reversal above 1.1800. Here is how it works. If price spikes above 1.1799 during London or New York, taps, or barely breaches 1.1805, and then immediately rejects with a sharp 15-minute bearish engulfing candle closing back below 1.1795, that is the entry trigger for a short trade. You are fading the breakout, betting that the negative divergence on the 60-minute MACD plays out and the bull trap snaps. Entry is at 1.1790, immediately after that rejection candle confirms. The stop loss for the aggressor is extremely tight, 1.1815, just 25 pips above entry. The logic is simple. If price re-reclaims above the rejection zone and breaks higher, your thesis is wrong and you get out immediately. No arguing with the market. The target for this short is 1.1740, which is the 4-hour 20-period moving average and a 50 pip gain, giving you a 2-to-1 risk-reward on the trade. If price reaches 1.1740 and shows signs of support, cover the entire position. Do not get greedy on the aggressor. You are fading a bull trend, and the move will be sharp but short-lived. Target 2, if you must have won, is 1.1710, but only if the breakdown accelerates through 1.1740 without any bounce. That would extend the profit to 80 pips, but the probability of reaching that target on a countertrend short is lower, so size accordingly. This is a 1-to-1 risk-to-reward scalp setup dressed as a reversal play, and it only works if you are disciplined enough to cut it fast when wrong, warning on the aggressor. This is a countertrend trade against a daily and 4-hour uptrend. The probability of success is lower than with the sniper or the active trader. You are trading a potential bull trap, but the structural trend is still bullish, so this is a tactical short, not a swing position. Do not marry this trade. Take the profit and move on, or take the small loss and flip long if the breakout actually confirms. Understanding when you are trading against the trend is what keeps you alive when the trend steamrolls your counter trade. Let us do one more interaction check. Type in the comments whether you are taking the sniper breakout long, the active trader dip buy, or the aggressor fade. I want to see where the community is leaning. Are you patient, active, or aggressive today? Drop your strategy choice now. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact news. Events like FOMC minutes or ECB press conferences, and stops are absolutely non-negotiable. A stop loss is not a suggestion. It is your survival mechanism. Move it to break even when the trade works, but never widen it when the trade goes against you. That is how small losses become account-destroying losses. Protect your capital first. Let the profits take care of themselves. If you take away only one thing from this entire breakdown, let it be this. The most critical level for the next session is 1.1670. That is the floor. That is the line that separates a healthy bull trend from a structural reversal. Everything above that level is buyable on dips with proper risk management. Anything below that level and you need to completely rethink your directional bias. 1.1670, write it down, tattoo it on your brain, whatever you need to do. Tomorrow we have US CPI data coming in, and that is going to be the fundamental catalyst that either launches euro to US dollar through 1.1820 or sends it crashing into the 1.1670 zone. The inflation print will define the Fed expectations for the next month, and that directly impacts the dollar side of this pair. I will be breaking down the CPI impact across all 8 assets tomorrow, so you do not want to miss that session. Set your notification now if you want the full breakdown on Bitcoin and the S&P 500 divergence that I mentioned earlier. That video is live on the channel right now. Click the end screen, watch how institutional flows are positioning in risk assets, and understand why the correlation between crypto and equities is cracking. That analysis directly feeds into your euro trades because risk appetite is the tide that lifts or sinks all boats. Smash the like button if this analysis gave you a clear, actionable plan for today's session. Subscribe and hit the bell if you want institutional grade levels on 8 assets every single day. The market does not wait, and neither should you. I will see you in the next one. Trade smart, trade prepared, trade profitable.